Welcome and thank you for coming out to Startups Uncensored number 17. I am Jason Nazar. I am the co-founder and CEO of Docstoc.com.
All right, boys, we're going to teach everybody here how to raise some venture capital. I like it. Let's do this. Let's go down the road, do introductions, let everyone know a bit about yourself, about the firm. We're going to keep these short and snappy so we can get to the questions and people can pick your brains on how everyone here can learn how to raise venture capital. Jim, let's start with you.
Hi, everybody. First off, thanks, Jason. This is an awesome event. It's great to be here. Came down from Silicon Valley. Trinity Ventures is where I work. We're a 25-year-old early-stage venture firm. We probably do 60% Series A, 25% Series B, and then everything 15%, 20% other of seed or special situation later stage. We're on our 10th fund. We closed $310 million last year in March of '09. And we're active in the Southern California region. We have a company called ID Analytics and a VOC in San Diego area. And we have a company called Perfect Market here in the LA area, which Rustic is also involved with. And as far as myself, I've been an entrepreneur and venture investor for the past 15 years. On the venture side for about the last 5. First 2 companies I funded, one was called Bix. That was basically YouTube meets American Idol that Yahoo acquired for about $50 million. And then CubeTree, which is a second company, is a SaaS app that basically does Facebook for business. Just got acquired a couple weeks ago by SuccessFactors, also for about $50 million. And been involved with probably a dozen other companies that we could talk more about later. So,
great, thanks, Jim.
Nate Redmond, Rustic Partners, here representing Los Angeles and Southern California. We help entrepreneurs build great companies, and we focus in 2 areas, the internet and in energy. We think of ourselves as early stage investors, which for us is something which is essentially anywhere from seed, which is company creation, on through to being the first or second institutional investor into a company that is kicking into a growth phase. And clearly with a base and center of gravity for the firm being here, we also have an office in San Francisco and are looking up and down the coast in addition to some other places. And the key elements of our firm, I think you've heard Jason talk about before, but we certainly look forward to getting involved with more of you over time here in Los Angeles.
Great. I'm Josh Stein. I'm one of the general partners at Draper, Fisher, Jurvetson. We're typically the first or second most active VC in any year, and we're probably best known for being global. We have offices in about 16 cities around the world. Some of the companies that we backed that you might know would be Hotmail, Skype, Baidu more recently. I focus on software generally, so that would include consumer media and internet, and also enterprise software and SaaS. And we're pretty omnivorous like Rustic Canyon. We'll write checks as small as $250,000 all the way up to 25 or 30 million.
I'm Tom Ball, partner at Austin Ventures. We're a pretty homogenous group up here, it feels like. We're on our 10th fund as well. We've been around for about 27 years, $4 billion under management. Our 10th fund is a $900 million fund. That fund will probably be about $300 million early stage venture capital and $600 million later stage growth equity. We're pretty active in different parts of the country. We're in a few deals down here in Southern California. We're in one in San Diego called Mojo Pages. We're in Active.com, which has been around for quite a while. Another one, we backed the MySpace founders out of Los Angeles here. We bought a company up in San Francisco called MindJolt, so Chris DeWolf and Aber and Colin and Josh. I was an entrepreneur before I joined AV 5 years ago. I started a couple companies, one down here in Southern California called RazorGator, one before that up in Silicon Valley called eCoupons.
Great. So first off, I just want to thank everyone for coming out here. Besides Nate, all the panelists here came from out of town, either from the Bay. Tom obviously came from out of state. One of our goals was to bring in venture capitalists that many of us might not get a chance to meet otherwise who weren't just part of LA. So I want to let you all know a bit about who our audience is. So let's go through a series of questions just to show them kind of the makeup. if you have started your own company or in the process of running your own company, raise your hand. All right. And so how many of you have already raised venture capital or in the process of trying to raise or thinking the next year you're looking to raise venture capital? Okay, and keep your hands up. So of everyone in the room here looking to raise venture capital, keep your hands up if you've raised any money to date for your company. And how many of you have raised in excess of $250,000? All right. So that gives you a sense of who it is that we're dealing with here.
We should do like an Oprah moment, like you're all funded. Everybody gets $1 million.
That's a good way to make friends.
And Josh is on your board, unfortunately.
All of you. I'm fine with that. I have no objection whatsoever. All right, so Tom, I'm going to start with you. And one of the things I like to do is make sure that the talk is relevant to the audience here. So a lot of the folks that come out to our events are early on in the process of starting their company. You saw that many of them, while they're looking to raise money, haven't raised a lot yet. Why are a lot of them never going to raise venture capital? Never going to get it?
Well, where do I start? I think when we look at deals that are coming in trying to raise money, I'm actually probably the guy, and I hesitate, is this being recorded and going to be streamed on YouTube or anything? Because my partners get mad at me sometimes for this, but I probably tell a decent percentage of people that come in that you shouldn't raise venture capital money because it's not right for everybody. You get a boss, you have expectations that you have to be aligned with ours, and a lot of you, I would suspect, have businesses out here that are great businesses, but just aren't right for venture capital. We're investing out of a $900 million fund. These guys are investing out of big funds. We're playing for fairly large outcomes here, and our investors gave us that money to try to make money on their money. So some of you may have great businesses that you can have be what I would classify as a lifestyle business that's probably the envy of all four of us up here on this panel that just isn't right for venture capital.
And so, Josh, can you speak a little bit about what are the check boxes that have to apply for a business really to qualify to get venture capital? How does somebody know if their business is one that's applicable to raise VC and when they should go down that route?
Yeah, I mean, I think I'd agree with a lot of what Tom said in terms of what do you want to do with the business? How quickly do you really want to grow it? Do you want to have, I don't know about boss, I'd say probably more partners, but very opinionated partners certainly. I think probably the biggest.
You ever fired a CEO?
Maybe. Partner. I think, wow, touche, man. So we're going to go there right off the bat. All right, this is going to be a fun one. I think the biggest check mark is probably market size. There's so many great ideas. We see them all the time that are just good businesses. And if you're really honest with yourself, getting to 20 million, as an enterprise value would be just a fantastic outcome. That'd be 3-4 years of really solid work. And if you own 80% of that, that's great. I mean, that's really good for you. If you raise venture capital and you sell for 20 million, you're probably not making any money, right? And everyone's pissed off. Even your VCs are angry. So, I'd say the biggest one is market size. Other than that, there's experienced management team, differentiated technology. All those are kind of all flexible. I mean, I've seen exceptions to any of those, but I'd say market size is the single biggest one.
And so, Nate, what are some of the things that you're looking for when you go to invest in a company? When you've actually decided to make a decision to invest in a company, what are the commonalities across them that they're applicable for, let's say, a Series A?
So Josh mentioned market. The classic characterization is to look at team, obviously, and not just thinking about the technology, but the application of that technology, and then the how that allows you to set up and alter a business model. And so when you think about the market, and you may be a company that actually looks at a big space but has a kind of a landing point or an early area of traction with the notion that you're really going to expand out functionality and expand out your access to a market over time. And that is certainly something that we encourage, to be able to have kind of clear early wins and being able to own and become the leading functionality within, even if it's a narrow space, with the opportunity to broaden out. But first and foremost, we do look to seek to work with, help, and support an entrepreneur who is going after an opportunity. And I think that as we have looked at investing at various parts of the capital life cycle and company formation life cycle, you tend to weight some things over others, but generally it falls into those characterizations or those segmentations.
And then Jim, can you talk a little bit, let's start from the beginning. I mean, what are the kind of returns that a venture capital firm is looking for? And can you explain a little bit about, the portfolio theory, how you're making bets on lots of different companies and maybe expecting not all of them to be successes, but a couple of those that need to carry the fund, and why that's germane to you needing large returns?
Yeah, I mean, the challenge for venture firms is to make multiples of the fund size that they're investing. So Trinity's $300 million fund, the goal is to make 900 or 1.2 billion on the fund, a 3-4x it. And when you kind of think about that, you are getting 20%, 30% ownership stakes in companies, and so you really fundamentally need to be investing in companies that get to billion-dollar plus type exits. And so how many of those are going to happen in a portfolio? Probably only 1 or 2 if you're lucky.
And how big is a portfolio?
And a portfolio is, for us, it's 30, 40 companies. So I'd say, on 10 companies, you're hoping that 1 will have a, multi-hundred million to $1 billion exit. You're hoping that maybe 2 or 3 will have that. And then I'd say maybe 4 or 5 of the others, you're going to assume it's going to have a 50 to 250 type of exit. And then 2 or 3 of the others will just be total, zeros and craters. So that's kind of the challenge when, Josh talks about market size, and you're looking at companies that to invest in, you're really kind of saying, all right, well, does this company have the potential to become a $1 billion plus type of exit? And that market may not exist today, but you have to see adjacent markets that company could go and disrupt. And so, for instance, I know there's a number of companies looking at around kind of the digital living room today, and the cable, telco, cable TV market is a massive, I think $70 billion of advertising that's spent on television advertising today. And I think that's a really interesting market that a number of companies could theoretically disrupt and capture a big chunk of that and create multi-billion dollar outcomes in. But the path to getting there is the real challenge, but also the opportunity.
Okay. So I want to open this up, this next question up to all of you. The fact is that most of the folks here today that are looking to raise venture capital are probably a little bit early for it. They either don't have the revenues or the scale that would justify it. Some of them may not even have a product that's live. Having met a lot of the entrepreneurs that come regularly to our events, I know that a lot of them are early for venture capital. Sorry, I'll turn this off. I just need a timekeeper. Alon, will you let me know about every 15 minutes? Thanks. So I often quote Dave Travers that gave what I thought was the best advice I ever got on raising money, which is tell people what you plan to do early on, come back to them, tell them that you've hit those goals in the time period that you said or even sooner, do that cycle multiple times, and by the time you actually go to raise money, they'll have had a chance to see what you can do. My question to each of you is, for the entrepreneurs in this room that may be a little bit early to raise venture capital right now, that they wouldn't have a chance to get it, what are the things that they need to do over the next 6 months to put themselves and their businesses in a position so that you'll give them that first check for $3 or $4 million? And Nate, if you want to start, that'd be great.
Probably more than anything else, it is, and I'll pick up off of Jason's thread, it's showing trajectory and building the fundamentals of the business. I mean, the elements around capital raising are such that it is rare that you can lay out in 3 months, in this month or in this week, certainly, I'm planning to raise venture capital, and I'll kick off the process, and I'll take 2 months, and so on. Even for folks who've been through it multiple times, it's not that predictable of a process. And given that, you continue to focus on the fundamentals of your business and track out against the milestones that lead to value creation events. And you look at that on a day-to-day basis, and as you start to lay that out, obviously, as a shareholder and as a founder, it's most interesting to find those points where you can actually demonstrate that real value creation and take that out as a very interesting point. And then, then you always have some discussion or negotiation around how much to capture that in the value of the deal. But fundamentally, you're looking at continue to build the business, continue to create value, form the relationships early on, track them through time, and show progression and trajectory.
So, and Josh, what qualitative things do people need to do? I mean, let's just assume that there's certain numbers that people need to hit. What are the intangibles that someone's going to do between now and 6 months or 9 months from now that's going to get you to like somebody enough to say, okay, I'm going to do this?
Yeah, I mean, I guess if you're too early, my advice would be don't go raise venture capital. I mean, just save yourself the time. I think too many first-time entrepreneurs. I was an entrepreneur for 10 years prior to being a VC and started a number of companies and raised money from VCs. You forget that once you take venture capital and once you start hiring employees, I mean, you're in it. You got to make it work at that point, and you're locked up for 4 or 5 years, sort of best case, even if it's a bad company. I mean, you got to ride that thing. It's like the captain, right? You're going down with the ship no matter what. Before you put that much of your life on the line, you want to make sure you have a business, right? So I'm always kind of amazed when people try and raise money with just a PowerPoint or an idea, having done no testing. If I give you the money and you sign up 10 people, it doesn't work. What are you going to do, right? So I would go out there and I'd get the data. There's also no excuse now. I mean, 10 years ago, you had to raise money because it cost a lot of money to build software. I mean, you don't have to buy servers anymore. You get that all online. You can build a prototype. Just go to Odesk, right? You can put for $5,000. You can say, build me Craigslist for movie stars, and someone will knock that out for you in a week, right? No sweat. If you want to know if there's a product market fit, I have some of the smartest entrepreneurs I know. They run AdWords campaigns for products that don't exist. So they advertise their product before they built it just to see what kind of conversion rates they get. Brilliant, right? It costs them like $1,000, and they know if they have something. I mean, I would do all that kind of stuff off of 10, 20 grand, which, scrape together from friends, family, whatever, and make sure you have a real business. I think, if you want more granular suggestions like that, there's a fantastic site run by 2 of my friends called Venture Hacks. They talk about all kinds of stuff like this. I think those guys really have it nailed.
Yeah. So one of the things that I've told you this before, that I appreciated about you the most is when we were pitching for our Series A round, you actually said, we're not going to invest in you. And there's what a lot of people don't realize the first time they go to pitch is that you won't get a definitive answer one way or the other. And you actually saved us a lot of time. Can you talk about that a second and what people should expect in terms of sometimes VCs not necessarily getting back to them and why they won't say no?
Well, and I'm glad you still think well of me. Yeah, so I think it's really hard to know. I mean, I think it's really hard to know if a business is going to work early on, and so I think it's not like we have a crystal ball. And a lot of times, some of these ideas just walk in, you're like, nope, that's just really dumb. Like, that's just the stupidest thing I've ever heard, or you're a complete bozo. And those are pretty much the easy ones. And then there's like that really rare one when they come in and you're like, this is the best thing ever. And even then you're wrong like half the time. Almost everything else is sort of in between. I think, VCs, we don't want to piss off entrepreneurs because like you come in, you're a little early, whatever. We tell you no, and then like 3 weeks later, it turns out, you've got like 10 million users and now you're like the next Facebook and whoops, we pissed you off. So a lot of VCs are basically cowards. Like they don't want to say no because I'm talking to LA. I mean, geez, this is like, this is the region that invented this, right? In the movie business. It's like, no, don't call us. We'll call you, yeah, you're great. You're beautiful. We love you,
I used to call it the VC blow-off. I mean, and I hated it. The VC blow-off is, I'm just not going to call them back. And you'd email them, it's like, well, what's up? You told me you'd call me tomorrow. And they'll just blow you off and ignore you because they retain option value. So if you did grow to 10 million users, they've got the option. It's like, oh, I meant to call you. Congratulations. I want to invest. It's like, oh, you did like me.
Yeah.
It's,
So
you
as
know,
an
it's
entrepreneur,
much like my high school dating career.
Two points you can take from Jason. I think one is you got to be persistent, because the other thing is like you go into a meeting and you have like all the best intentions to follow up, and then like there's some like board emergency and you got to fire a CEO or whatever, and it's like you just get busy and you forget. Don't be afraid to like re-ping the VCs like with some frequency, and it's like, hey, I saw this article, I thought you might like it, and by the way, what do you what's the story, right? The other thing is I think take the feedback well. A solid half to 2/3 of entrepreneurs, when you do tell them no, they get like really pissy about it, and they'll want to argue with you and debate it, and I get it, because it's like they're entrepreneurs, they're passionate, that's their job. But if someone tells you no, it's really unlikely you're going to like convince them to yes right then, and I think it you're sort of making that problem worse. So I would say be persistent, but if someone and try and get the no, but if someone gets the no, say great, thank you, and I'll come back in 6 months, and I'll, with showing you that I've actually made progress.
And I think building on that, it's also, the best, not the best, but oftentimes very good CEOs are former sales guys, and they know how to get the order. So if they don't get the order, what's a good sales guy say? Well, what does it take for me to get this order? Right. To your point, Jason, and it's to me, well, I'll tell you 3 things I'd like to see you accomplish before I'd want to talk to you again.
Great. So can you talk, one of the things that, since I've known you, you've always struck me as someone, Tom, that was very entrepreneur-centric. And what's unique about all of you is every single one up on the panel here has been an entrepreneur. But you in particular have always seemed to really be drawn to particular entrepreneurs, and that's a main factor in why you choose to work with people. What are the characteristics in the folks and entrepreneurs raising money that are imperative that you want to see? And what are the things that are absolute red flags that when you see them, you're like, I don't care how good the business and metrics are, I just would not work with this schmuck?
Yeah.
I like that.
I think the thing that matters to me a lot, and a term that gets used around our shop a lot, is intellectual honesty. Of just when things aren't going well, just be honest enough to admit it. And you can kind of draw that out of someone of like, what hasn't worked so far? And it's like, oh, everything's worked. It's been perfect. It's like, bullshit. Not everything works. So I think you have to have kind of a degree of intellectual honesty with yourself and with others. And I guess the opposite of that, the thing that would really turn me off quite a bit, is being too promotional. Just being too promotional, it goes back to the sales thing. I think the best salespeople are not overly promotional. They listen a lot. If you ever learn how to sell, it's you listen more than you talk. So traits such as that. And then, one that I've appreciated more in the past few years is just general scrappiness. So to your point, you can start something with $10,000 now. If you haven't done the kind of $10,000 test yourself, and you need my money to do that, well, how scrappy are you going to be when I give you $3 million? You're going to blow through the $3 million, and what are we going to know at the end of that? So this whole kind of lean startup philosophy and being scrappy, I think, is a good trait as well.
So Jim, I wanted to ask you a little bit about the art of the pitch. So we talked about this. Dave Travers and I have talked about different entrepreneurs. Ben Elowitz, who started Wet Paint, being one of the very best folks at raising money. When Jim Lazone was pitching Clicker, you said he gave the best pitch you've ever seen in an all partners meeting. Let's talk a little bit about the art of the pitch. When you get in and you meet either an individual venture capitalist, or maybe it's serious enough that you go to an all partner meeting and you're pitching multiple partners, what are the folks that just nail that pitch, and what are they doing that maybe there's another business that's got equal or similar metrics, but what are the qualitative things? How are people positioning their business and talking about it such that it's going to get you really excited?
I think there's 2 main things. I think the first thing you got to do is just establish credibility about yourself and the people that you're working with on the team right up front. I think some people kind of bury the team slide or don't talk about the team, and they'll talk about problem or market or space or competitors. First, I'd say the key thing is, you're kind of in an interview setting. Talk about yourself, not in an overly promotional way to Tom's point, but sell yourself. You're kind of on the line. This is your chance to shine. Don't be shy. Sell yourself. Be promotional to the extent that it's true and can be validated. So after credibility, I think the second thing is just describe around the market potential and how, even if it's a nascent market, how you believe the market will evolve such that it can be really big. So big market, established credibility of yourself and the team are the two key things to get VCs leaning forward.
So what's the best pitch of a company you've ever seen? That you were in the room, these people gave a pitch, just blew you away.
I've definitely seen a lot that have knocked my socks off. I guess the ones that really strike me are, take Gurbash from G-Wallet, is a company that we funded in the virtual offer space. Here's a guy who's 27, 28 years old, and he was starting his third company. First one he bootstrapped and sold for $40 million when he was age 21 or 22. Second one he founded Blue Lithium and sold that to Yahoo for $200 million at the age of 25. And then was starting G-Wallet to be a fast follower after the Trial Pays and the OfferPals of the world. But when you looked at the guy, he was a real, I think the term that we use sometimes internally, and I've heard other VCs throw around, just a force of nature. Someone that had the relationships, the tenacity, the charisma, just kind of this, rock star type of persona that makes you think, wow, this guy will break through walls. And so that was a big reason that we ended up funding him in a very competitive category. And, so far, so good.
Do you think was that just the way he was born, or is that a learned skill?
Yeah, I think you could be either. I think for him it was actually partly both, because he was born I think he was actually born in India, and then immigrated over with his parents, and they came from a very poor background and decided not to go to college to start one of these companies so that he could help pay the bills and so it was partly through the school of hard knocks, and partly of him just having this kind of Steve Jobs-like DNA that I think when you have both of those things, that's when you really kind of have an amazing kind of wow type moment when, as an investor, you're like, okay, reaching for your wallet and putting money in his pocket before he leaves the room.
So same question to you, Nate. What's the best, and what's just the deal that you've seen that pitched, blew your socks off?
Well, like Jim, I'll generalize as opposed to picking one, and and just point to the passion of the entrepreneur. And I think Jim spoke to some of the dynamics around it, which I would encapsulate into the passion. And it's also reflected in the tenacity, but you just believe that the individual, as any entrepreneurial endeavor goes through ups and downs, will continue to push it forward and has the desire to break through those walls. I think from a pure presentation or pitch perspective, it is bringing just a sense for the company, the culture of the company, and the business itself and the business opportunity into the room. And you have minutes in front of a group, not just even 45 minutes or an hour and 15 minutes that you're allotted, but it's really you have 15 minutes up front to either grab the group or not. And some would certainly say it's shorter than that. And so how do you get people leaning forward and excited and enthusiastic about the opportunity set? And then you're just building credibility in sort of 5 or 10 minute increments after that until you bring it to a point where the interest level is high enough that there's rapid follow-up. The other piece of advice that I've heard from entrepreneurs, which I think is correct, is if you haven't heard back from the VC within 2 or 3 days, assume that they're not interested enough to be making the investment. And unfortunately, it's true, as Tom was saying, that a lot of VCs just plain don't follow up, and even those who do, if it's not high enough on the radar screen up front, you put them on the back burner, and you are developing a relationship with someone who's going to lean forward and do it at that point.
So does that mean if someone doesn't get back to you, does that mean for sure they're not going to invest? How do you know when to be persistent versus just to move on to the next?
Yeah, so that's why I say put them on the back burner. It doesn't necessarily mean that they absolutely won't invest. It means you're putting a pretty clear probability set against them just right off of that data point. And so if you don't have something off of the first 3 days, then assume that they are just a low probability. You can certainly continue to build a relationship, but most likely, if there is getting an investment is very much a process with a trajectory to it. And you are building credibility, you're building you're building towards this deal. And if without that early momentum, the probability that you will quickly later on build to that point is much lower. And so you have that shot up front to kind of really get the ball rolling. If you do, then it's incumbent upon you to be following up and to be working in a way that you continue to increase the speed and velocity.
Now, I'm pretty sure you're not running for office. Are you really going to dodge my question of what the best company is pitched? I mean, I know we're at the Milken Institute and lots of, candidates come here, but last I checked, your name wasn't on the ballot anymore.
The most passionate entrepreneur I've seen was Jason Nazar.
Just for that, I'm going to have to let it go. Now I know you are running for office for something. Maybe class president. Josh, what are the biggest mistakes that people are going to make? What are the things that they do? They get in front of you. You're going to give them half an hour of your time. You're going to put them in front of a partners meeting. What are the dumb, bone-ahead, dumb-ass things that people do that ruin their shots to have you get interested in investing in their business?
Geez, I don't know. It's a tough one. It's funny. I was thinking about the best one I've heard, and it's a guy that came in and he kicked his feet up on the table, and basically said, maybe you can invest if you want. It was Facebook. I mean, so it was obvious, like it was a super hot deal, and kicked his feet up. We didn't care. We still didn't get the deal.
Did he just put his feet on the table?
Yeah, it wasn't Zuckerberg. It was Sean Parker walked in and he just literally kicked his cowboy boots up on our conference room table.
And then I would have actually polished his cowboy boots.
Yeah, when we protections. So we offered him money on the spot. It's pretty funny. When 90% of your users were logging in every day at that point, literally like 90% of the registered users were logging in every single day. That was probably the coolest pitch I ever heard. The most compelling entrepreneur is actually a guy we've backed now 3 times, Elon Musk, who last year, or maybe it was 2008, managed to ship the first electric sports car and launch the first commercial private rocket into space, which basically makes him awesome. Can you imagine like going to like school, like, what does your dad do for work, and having to go after him? It's kind of crazy. What's the really dumb stuff? Showing up late, futzing around with your stuff for like a half hour, not being prepared, not having your stuff together, not having the story well told. Trying to think of any real dumb stuff. It drives me nuts when people come in. Like someone has told some fraction of entrepreneurs, like 10%, that you should like interrogate the VCs about their firm for 10 minutes before. Like, you're there to tell us about your idea. I mean, it's that's the most efficient way. And so I'm happy to tell you something about DFJ, but honestly, I'm a little surprised you haven't, we have a website, we explain it all. Like usually the person that's introduced you to us probably can tell you some stuff. You should know who I am and what we do and what our investments are ahead of time, because that's not a good use of the time that we have. Other than that, I don't think there's any hard rules.
Okay. So Tom, same for you. What are the pitches who are the folks that have blown you away the most, and what are the mistakes that you often see people make?
Yeah, we had a guy recently, he'll probably watch this and realize it was him, who showed up literally 30 minutes late and didn't have a deck. Sat down and he's like, okay, what are we going to talk about? It's like, well, I don't know. You came here. Why don't you tell us about your business? We had to draw everything out of him. He wasn't in. Why did he come? I don't know. So obviously we didn't invest. I don't think he would have taken our money anyway, though. It's the stuff we talked about earlier. You have to. All the positive things are there, and I'm not going to tell you the best one I've ever seen. I mean, we've got some good companies in our portfolio, and they all kind of share a common trait of passion, just have their shit together. They know the metrics, they know how they're going to make money, they know how to build a team. They've kind of identified the key risk areas of, and I kind of think in simple terms, there's on a lot of these deals, there's technology risk, there's product market risk, and there's execution/team risk. And they've got an answer for every one of those, and it's a good answer, and they can get through it quickly.
All right. One small piece I'll put in, don't bring 4 people to a meeting unless all 4 people are going to talk. If you have you're, a core part of your team there and only one person does all the conversation, then it really raises questions as to, in my mind, as to some of the dynamics across the team, and also I think it's a poor use of time.
All right, so Jim, what is the deal with these ridiculously crazy valuations that are happening in the Bay? A year ago, Sequoia puts out a presentation that you can find on Docstoc, talking about how the venture capital industry is coming to an end, the whole world's blowing up, and a year later, you guys are chasing these deals like Quora and Foursquare and giving ridiculously insane $100 million valuations for companies that not only don't make any money, they haven't launched. So why are you guys that are so smart and have so much money doing this kind of stuff?
They're going to be huge.
But really, like, what's the deal with these insane, crazy valuations?
Yeah, I mean, maybe just stepping back for a second, like the 2009 was abysmal for raising money. So I think you saw a ton of savvy, experienced entrepreneurs just sit it out. And a lot of really good existing companies that were already funded basically got additional runway from their existing investors. So post, one of my companies, CubeTree, one of these companies that recently sold, they were raising a Series B round last summer, and it was just, it was just a nightmare. And then post Labor Day, I got to say, something flipped in the market, in the venture community, in the startup community, and people started leaning forward and opening their checkbooks again. And the company ultimately raised a Series B round successfully. And Trinity, just as one data point, we did maybe 10 investments last year in total in 2009, but 6 of those were post Labor Day, between Labor Day and the Christmas holidays. So you had this pent-up demand as the macro environment improved of high-quality people and companies looking for money. And that carried over and spilled into Q1. And so you saw a lot of companies continue to look for money. And companies like Foursquare or Quora were just heads down in 2009 building great products that were generating a significant amount of, at least in Foursquare's.
But at the end of the day, isn't it just because you're competing with other VCs? I mean, are you ever going to pay that valuation unless 3 other VCs have a term sheet in and you're trying to beat them out?
Well, I think it is a super competitive environment, but I think the smart VCs, and we definitely, kick ourselves for not being the smart VCs in some situations, are actually going to go and pay the premium price before that company actually goes out there and creates a mini auction. And if possible, preemptively take it off the table. Sometimes that works, sometimes that doesn't, but that's a typical strategy that, that a venture firm will go and say and look at somebody like the Foursquare guy, Dennis, who started a company before and successfully sold it to Google, and say, okay, well, before he kind of creates this feeding frenzy, how can I get this thing off the table? And sometimes it works and sometimes it doesn't. And then he goes into feeding frenzy mode, and all of a sudden, he's got, venture firms flying him around in their private jet and all other kinds of crazy things to woo him to, take their money. So, it's kind of a funny dynamic where I think sometimes it's merited, and Facebook was another one of those examples where we got the call from Zuckerberg and said, hey, you got a term sheet at 90 pre or 80 pre or whatever that Excel was funding it at, and you got to decide today as to whether you're going to match that or beat it. And this was just kind of crazy to the partner who fielded that phone call. And you got to really, that's kind of where the really smart VCs differentiate themselves, is they're able to kind of step back and say, okay, of all these kind of chocolates that are passing by in the Willy Wonka factory, I'm going to pick out that one and pay $1 bajillion for, because I know it could be worth $20 bajillion, in a year or two from now.
So every single one of you have been an entrepreneur. If you were shopping your own venture capital deal right now, every single one of you would want to have as many term sheets as possible so that you had as high a valuation, so you gave up as little as you have to for that company. But that's not the position you're in. You're in the position where you have to bid on a company, and you want parties to be aligned, but you want to get a good offer. So how do you reconcile that?
I don't actually agree with that. I wouldn't, I'm not out, if I was an entrepreneur again, I would not be shopping for term sheets. I care more about who my partner is. or boss, but who my partner is, because you're in that for the long haul with them, as well as you got to be careful as an entrepreneur not to just shop for the highest valuation, because you set yourself up for a bad day someday in the future when you have to raise more money if you've raised money at too high of a price, because you're the one who's going to get hurt the most.
So talk about that a little bit more. You're the entrepreneur. What should you be looking for in a venture capitalist? Why is one venture capitalist better than another? Isn't all their money green?
Well, I do think all their money's green. I mean, I think that's the hard part about being competitive with these guys is we're selling a commodity in many respects. I mean, we're selling money. It's a commodity. So it's, what do they know about your space? How's their network? How are they going to help you? Are they going to be there when you need them? You know, there's a lot of attributes that I would look for. And having sat on the other side of the table, I didn't know always what to look for, but I understand a lot better now.
How do you know if a venture capitalist is going to be there if they need you?
Check their references. You know, and maybe they shouldn't be there. If, you know, it's sometimes the tough love conversation of it's not working, you know. And so, but if it's working and they, you know, you want to make sure they have enough money if it is working. Yeah, you can't ever predict if they're going to be there, but you're getting married to this person, essentially.
So from your standpoint, an entrepreneur should be less concerned about valuation and more concerned about finding the right partner.
Yeah, that's my perspective.
I think it cuts both ways. I mean, you know, people often talk about venture financing like it's a liquid market, you know, buyer, seller, getting an exit. I think Tom kind of nailed it. You know, it's just a step in the process. You know, the difference between a 10 pre and a 20 pre might just mean you're getting a little bit more money for the exact same dilution. But if you get a jerk on your board who's going to make your life hell for the next, you know, 8 or 9 years, it's like getting married with almost no possibility of divorce. I mean, it's just brutal. So I would take the time. I'd get to know the person. I'd talk to their existing CEOs. I'd, you know, make sure that I felt the connection with them. I think also, you know, raising too much money. Honestly, what tends to happen is you start spending too much money, and it's a cycle that gets harder and harder and harder to get out of. So, you know, there's where you really want to pour on the gas in a startup is once you know exactly what you're selling to who for how much, and you know that if you put X dollars in a marketing channel like AdWords or, you know, telemarketing, whatever, you know exactly how many leads are going to come out. That's when you just pour it on and you go into hyper growth mode. And then, you know, yeah, go nuts, because you're talking about investors who are not going to be control investors. You're going to be raising money at a high price and the world's kind of your oyster. But early on, it's, you know, I would look at it like you're bringing in a business partner, and I would spend the time.
So to that point, Nate, I've asked a bunch of questions of what are the things entrepreneurs do wrong, what mistakes do they make when they pitch. You know, I picked every one of you specifically because you're each someone that I can turn to and say, I look up, I respect. You know, I have a lot of, I think each of you have a lot of integrity and have a great reputation in the community. That said, there are a lot of venture capitalists that are dumbasses that people talk shit about, that are uniformly disliked. So how do you as an entrepreneur and a first-time entrepreneur know when a venture capitalist is a bad venture capitalist? Like what are the qualities of a douchebag venture capitalist? I'm not giving you the easy ones, by the way.
Yeah, well, good.
I mean, you know, you all are people who've gone through life. I mean, I can usually tell most douchebags in about an hour. I mean, can't you? I mean, you can sort of tell pretty quickly. They sort of the same kind of characteristics. I mean, if your spidey sense is saying douchebag, it's probably right.
Yeah, so you know, across the distribution of individuals in the business, it's sort of easy to play with the folks on both ends. And the question is, as you try to sort through the vast middle, where do you draw the line and who are potential fits?
I mean, just tell them that venture capitalists they should never work with. Just while we're recording and on camera, who are the list of the 5 venture capitalists that you should never take money from, the partners, their home phone numbers, where their children go to school. Just lay it out for them.
Jim, go ahead. So,
who would you stay away from?
I think that the other quick qualifier I'll put on is obviously, you know, some entrepreneurs will fit well with a certain type of VC, whereas others it will take their spidey sense. But look, there are certainly VCs who have been successful in the business, who you would as an entrepreneur, your approach to building the company does not work well with this individual. And certain firms do have a culture, but it's really a reflection of the individuals or a subset of the individuals at the firm as to how they work with entrepreneurs, how itchy is their trigger finger, and how do they deal with that process of continuing to build and work with an entrepreneur. And you will certainly have some sense when you sit down, but look, I mean, we are going through a similar process as VCs in understanding entrepreneurs, and we certainly take advantage of the fact that we have an opportunity to meet with a lot of different entrepreneurs over the course of some period of time. But keep in mind, when you sit down with a VC, there's so much about timing and a whole bunch of other dynamics at play. Any one VC, will probably do on average 1 or maybe 2 or sometimes 3 deals in any one year. And we're just seeing, orders of magnitude of that in terms of number of deals. And so, whether or not they've perhaps have just done an investment or are working through a number of other things in the portfolio and are feeling distracted. So there are a lot of elements that play in, and therefore, I think it's hard to sort of set out targeting one individual with the idea that that's the only person that you will work with over time, unless you're really willing to be sort of flexible over time, or you've developed a relationship in sufficient depth.
So many of the folks in this room who are looking to raise venture capital don't have a Rolodex of venture capitalists that they can just call up. And so what's the process if any of the, once again, raise your hand if you're looking in the next 6 months to raise venture capital. Okay? And how many, keep your hands up for a second. How many of you have, direct access to more than, 3 venture capitalists that you could email or give a phone call to and they get back to you in the next 24 hours? All right. So of everyone that raised their hand and put it down, what are the things that they need to do to get a hold of you so they can get in front of you to talk about their ideas other than come to events like this? And how are they going to, get in your office and talk to you for half an hour and talk about their business? And let's say you do say it's a little bit earlier, not jumping on their business right away. What do they need to do to maintain and build that relationship with you?
Well, it's a trick question because the answer is email Jason and have him send it to as many VC contacts.
Qualified introductions.
Yeah, I think qualified introductions are great. Every firm's different. DFJ, we kind of think it's our job to look at everything. So I'm Josh at DFJ or DFJ Josh on Twitter. Like, just email it to me. I'll take a look at it. It's my job. But if you know somebody who I know who makes the introduction, it's better because that person is sort of saying, hey, I think this is a good person.
You may reply if it's somebody.
Yeah, right. But no, I mean we've found I found one of my best deals at a startup pitch event.
Yeah, it's qualified introductions for me. I mean, we read everything that comes over the website. We try to return every phone call. I got a business plan from a homeless guy one time that I read, and it's hard to find the homeless guy to give him his business plan back. But yeah, we try to be as responsive as we can, but you're going to have much better luck if it comes from a qualified introduction. If any CEO in our portfolio suggested we meet with someone, we would do it.
What about maintaining the relationship? I mean, you kind of alluded to it before, Josh, but you passed on our deal. We got other venture investment, but you and I have stayed in touch and often either hunt you down on Facebook, on chat, or send you notice of congratulations on a deal. I mean, what are the things that entrepreneurs need to do to stay in touch with you, maybe after you say no, so that they give themselves a chance to have you say yes later on? And that's, for all of you.
Yeah, I kind of, just to jump in real quick, the concept that I think of is drip marketing, and you guys are probably familiar with that with what you do with your customers. You kind of figure out how you get in touch with them. They sign up for your email newsletter. You start doing remarketing to them. There's other ways that you could continue to track the engagement with them. Same kind of thing with potential investors. You kind of view them as someone that you find natural ways to stay in touch with, whether it's sending an interesting article, running into them at an event, flagging kind of interesting deal opportunities that, from fellow entrepreneurs in your network to them. And then specifically asking about, in that, if you have that turned down phone call or that follow-up email, what are the 1 or 2 things that I should be working on, and then updating that person in a natural way about it. And I think creating that kind of dialogue is a really, it's kind of an artful thing, but it's also a best practice, I think, for keeping in touch with that with that potential investor.
All right, so how can folks get a hold of you?
Email,
What's your email?
jim@trinityventures.com.
What about Twitter, Facebook, any of those things? You want people to contact you that way?
Email is best.
All right, Nate, how can people get a hold of you?
Same thing, Nate at Rustic Canyon.
Any other networks you're on? Spanish social networking site that they could find you on, anything like that?
Sure, I'm on all the networks. They're easy enough to find just by my name. But email is good, and again, obviously coming through qualifier, it's harder to just sort of drop a call in unless it's really more of a leaving a message. And
give me a sample subject line of an email that's going to capture your attention.
Quick note.
That's the subject line, quick note. Cool. What about your name? Do you want to see your name in there? If you see Nate in the body of the subject email, you're going to be like, oh, my name's in there.
Yeah.
He opens all the ones that say Viagra too, I've heard.
That's the special folder.
Josh, you mentioned your email. Anyway else? Your home phone number?
Yeah, I like the suggestion of drip marketing a lot, and I think make it. Feel free to be oblique too. So it's you can send me an article you think is interesting. Doesn't can be an update. Actually, a lot of companies have these traction announce sort of blind email blasts. I think those are great. I mean, I know how to unsubscribe or send you to the spam folder if I don't want to see it. But once a quarter, send out here's the highlights of my business and here's what we did. And it doesn't have to be just to me. It can be a blast to sort of the people. I have probably 30 or 40 companies that have just signed me up to their traction list. I think it's great. And sometimes you're like, wow, these guys I made a real mistake there. I guess the other thing is, I think Jason and I I think Jason is a friend. We have a great relationship. I think, VCs are going to get maybe 20 or 30 investments in their career, or maybe less if your first 5 or 10 are not good. It's not like if we're not investing, we think your business is bad, or if we think your business is going to make money, we're going to invest. It's like sort of everything's got to be right. It's like, do you want to date somebody seriously? So don't take it as anything more than that. It's I think you can still have a really strong relationship with somebody. With guys like Jason, one thing I think about is maybe if it's not this one, we're both young guys. We're gonna you're probably gonna start 4 more companies. And
hopefully a Viagra company.
Hopefully, so things can change, and so I think just keeping a good relationship and being hopefully the interactions are useful both ways.
Tom, how can folks get a hold of you?
Yeah, it's T-Ball at Austin Ventures.
Okay,
T-Ball.
sounds good. All right.
The other thing I would just mention is don't be shy about asking for other introductions in terms of that follow-up. Because oftentimes there will be venture investors who say, okay, well, it's too early for me, right? And that could be code for a lot of different things. But don't be shy and say, okay, well, is there 1 or 2 seed funds, angel investors, colleagues that you think this might be a better fit for? And if that investor wants to remain in touch with you on a long-term basis to get a look at your next round or to have some kind of productive professional relationship, more often than not, they're going to open up the Rolodex and say, yeah, it's really easy for me to put you in touch with XYZ person.
So you're saying it's kind of like if you date a girl, and if then the date doesn't go well, you're like, hey, do you have any other friends that I could go out with?
I'm gonna disagree. I always find that question really awkward because it's like, what am I call someone up and be like, yeah, looks good on you. It's like, I'll volunteer if I want to hook you up with Ron Conway or somebody. I'll tell you. I always find that question really awkward. Like, do you know anybody else? Now, I do think it's totally fair game 2 months later if you say, hey, do you know anyone at Oracle? Or do you know anyone at Cisco or Google? That I'm totally happy to help you with because it's not the same thing like, well, I've passed on the investment. So I say, hey, this is a great entrepreneur. I know you should talk to him.
Yeah,
Pass somebody on to your cousin, but not a...
I think you have to earn the relationship, though. I mean, I always laugh when I meet somebody for the first time and they friend me on LinkedIn or Facebook, and it's like, I don't know you. So, and it, maybe they use the tool in a different way than I do, but you kind of have to earn your way into that. And I think, our relationship, Jason, we've got to know each other over time, and it's valuable to both of us to know each other, probably.
What I really just wanted to do is the following is, tonight I wanted to give everyone here an opportunity to meet folks in the investment community, not just from Los Angeles, but from the Bay. And I can first off say that I'm extremely appreciative for every single one of you that came from out of town. I know that you've got extremely busy schedules, but more importantly, I wanted to try to pick a group of folks that I really look up to and respect. Every single person on the stage is someone that I have the utmost respect for, I think has excelled in what they do, but most importantly is just a really good person. And Jim and Josh and Tom are all folks that, you know, if we go out at some point in the future and look to raise money, or other companies do, I would strongly encourage and recommend. And I really can't say enough about Nate and Dave Travers at Rustic Canyon and everything they've done for us. And what I can say is the best thing I think that came out tonight is I really do think who you work as a venture capitalist is of the utmost importance. And I think any company here that would have an opportunity to work with you would extremely benefit from it. And I know we have from working with Rustic Canyon and Nate in particular. I just want to say thanks. And will everyone please give them a round of applause.